In today's video, we're going to talk about 4 specific steps that you need to take in order to start investing, even as a beginner. I mean, start investing with your eyes wide open. When Joe and I got onto our investing journey and really got serious about it, we had to get really clear about our income, our spending. Did we have an emergency fund? All these things were really foundational in making sure that not only did we start investing, but that we were able to start investing for the long term in a sustainable way. And now, 15 years later, we're debt-free millionaires, and we're here sharing our journey with you on the Permission to Be Wealthy channel, where we have open and honest conversations about what it's like to build financial independence and wealth as a couple that looks like us. We now live in Portugal. We have our 2 kids with us, and we've learned a lot over the course of our 15-year journey. And so I wanted to share this video so that I could help you address maybe some of your fears, your concerns, or just in general, some of your questions that you might have about starting your investing journey. And if you like today's video, go ahead and give it a like and subscribe to our channel. Of course, if you have any questions along the way, go ahead and leave a comment below and let me know what other topics you would like to hear from us as we continue to post videos on this channel. No question is a bad question, and we love to hear from you. First things first, I am not a financial advisor. As a matter of fact, I am an ex-supply chain expert who spent over a decade in the supply chain planning and forecasting. We have our personal lived experience of what it's like to build financial independence and build wealth now as debt-free millionaires. And so you are responsible for doing your own research. This is not advice. This is an educational video so that you have a good sense of what options are out there for you so that you can tackle your financial independence journey. All right, so let's talk about why investing is important. And so investing means you're going to take your hard-earned money, you're going to invest it in an asset, and you're going to have some level of expectation that this asset is going to grow over time. You can invest in stocks, bonds, real estate. There are all sorts of assets that you can invest in with an expectation that your money is going to grow. Why do you want your money to grow? Well, if you have lived in the last, 5 to 10 years, especially in the last couple of years, you'd recognize that inflation has been a big, hot topic. And inflation is inevitable, right? Your dollar or your euro, whatever, wherever you are, is going to lose some level of buying power over the course of time. I think of inflation like this. When I was a little girl, I am one of 3 kids. My mom and dad would take us to this little drive-in burger joint, and we would get burgers for 20 cents. So literally, a family of 5 could walk away with $1 spent and 5 burgers in our hands. And I cannot think of anywhere that you can go right now and get 5 burgers for $1. And so inflation touches almost every part of our lives, and it's a reality. So if we're going to be on the winning side of inflation, we want to be investing our hard-earned money. Another reason why investing is important is investing allows you to reach some of your financial goals, whether that's retirement, being able to fund your kids, your nieces, your nephews' college, or any other financial goal that you might have. You can also unlock other streams of income through investing. So either you're going to draw from your investments over time because your investments have grown enough for you to literally live off of them, or maybe your investments pay a dividend so that you can live off of that dividend income. But the reality is if you get serious about investing, you can get to a point where you're no longer trading your hard-earned time or your valuable time for money. That's where Joseph and I got over the last couple of years, where I was actually able to leave my multi-6-figure job and not have to work 60 hours a week any longer. I can manage my time on my terms. I can build my business the way that I want to. I can spend time with my husband and my kids, and I can walk along the coastline here in Portugal and actually enjoy time and not be stressed about having to answer emails, worry about the SVP that is calling me and asking me for answers to specific questions. I can really just walk away from some of the everyday work stress and focus on some of the things that just bring me joy. So now that we know why we want to invest, let's talk about why all of us aren't investing. And there's 3 things that come to mind for me. Number 1, we've been sold this idea that investing is incredibly complicated and that we need somebody holding our hand, probably a very expensive hand holding, if you will, from a financial advisor perspective. But we've been told and made to think that investing is really complicated. The second thing is, I grew up thinking that as an investor, you had to have a ton of money to start investing. And as technology has advanced and as investing has become way more accessible across the globe. That is not the case either. The third thing is many of us believe that investing is incredibly risky. And one way I like to put this is if you don't invest, then you're on the other side of the equation, probably in a worse off situation because inflation has impacted your pocketbook and maybe other things, right? And so as I think about those three things, index funds have really allowed us to take away a lot of those things. Index funds are super simple. They're diversified, so you don't have to take on tons of risk by individual stock picking. And you can get into an ETF or some index funds for as little as $1 because you can now buy fractional shares out with different brokerages. In my mind, investing has become even more available, right? Accessible. And why not take the opportunity to have our money work hard for us even while we sleep? All right, so step number one is figuring out your numbers. How much are you making? How much are you spending? And how much of a difference or a gap do you have? So on the income side, you want to understand what your 9-to-5 income is. If you're a freelancer or a business owner, or if you have other streams of income, you want to aggregate all that information and understand how much are you making per month. Then you want to go get your spending history. So credit card statements, loans, bank accounts. Where are you sending money out on a monthly basis, and get that information for about 3 months of time if you haven't done this in a long while, and aggregate that information to see what type of trends or habits you have when it comes to spending your money. And if you're looking for ways on how to track this information, you can either go the automated way or you can go the manual tracking way. Some apps that do this more automated for you are things like Mint, but Mint is going away. That's what we were using. They are navigating people over to Credit Karma. You can use Empower, you can use YNAB, or you can use a trusty old spreadsheet, and I actually have a free monthly spending tracker that I'll link in the show notes below. And it also has a less than 5-minute tutorial on how to actually use that. When you're starting on your journey, I recommend that you use the manual approach because it forces you to get intimate with your numbers. For step number 2, you want to make sure that you have an emergency fund. And I looked up some information from Bankrate. They have cited that more than half of Americans are uncomfortable with their level of emergency savings. And that's in now terms. And so having an emergency fund is really important because no matter what might happen in your life, you have a fallback plan and money that's easily accessible for you to do something with. So step number 1 in the emergency fund space is make sure you have at least 1 month of living expenses established in your emergency fund. And so if you took step number 1 seriously and looked at your spending, you now know what you need to have 1 month of spending covered. Once you get that established, you want to move over to 3 to 6 months, and that just allows you to have a little bit of runway should something happen, like you lose a job or you need to take care of someone, or you have an unexpected expense like a busted pipe or a broken down car. All of these things are things where you may have to go dip into this money, and instead of having to take out high interest debt, you can rely on your emergency fund. The last thing I'll say about an emergency fund is you want to have your emergency fund in a high yield savings account. I have here on Bankrate their list of monthly high yield savings accounts that are giving the highest percentage of interest and return back to you. All right, so step number 3 is paying off your debt. So when I mean pay off your debt, I mean get effective with your debt. I mean focusing on your high interest debt first, and that means any debts that are over 7% or more. But the reason the 7% is because let's say you had debt and you were also invested in the stock market, and the US stock market delivers about an 8% return annually. So anything over 7% in debt is just eating a hole in what you could be making in the stock market. So making sure that you have a very clear plan on how you're going to address that high interest debt is really important so that you can make sure that you're having your money work strategically for you, even if you do decide to go invest in the stock market. All right, so we understood our numbers. We have an emergency fund. We have a very clear debt effectiveness strategy. And here is the 4th step. Now we want to start investing. My recommendation to you is to start investing in a retirement account. And so this is kind of like putting your mask on first and making sure that you've at least secured your retirement. And then we can start talking about investing for financial independence early. So when I talk about investing for your retirement, I typically talk about 3 accounts: a 401k if your employer offers it, a Roth IRA, or a traditional IRA. So let's talk about the 401k first. If your employer offers a 401k, you may have already been enrolled. You might have some level of contributions into it, and you might want to go check that out. The cool thing about a 401k is number one, you can contribute pre-tax, so you can reduce your taxable income. As you invest in your 401k, those gains are going to grow tax-free. And then when you go to withdraw in retirement, you withdraw and recognize ordinary income, but you will be paying long-term capital gains rates, which means you are going to be taxed at a lower tax rate than ordinary W-2 income. The other cool thing about a 401k is some employers actually offer a match. So you want to take a look at what your employer is matching and see if you could take advantage of that. The next account that you'd want to consider is a Roth IRA, and this is a really cool account. While you may not get the tax benefits up front at contribution, your investments are going to be able to grow tax-free, and when you actually go to withdraw your investments out of a Roth, those are tax-free altogether. You don't have to pay any tax later on in retirement. So what I like to tell people about a Roth IRA is that you get to plant the seed and might have to pay the taxes on the seed, but you don't have to pay taxes on the actual tree and all the branches and all the leaves and everything later on in retirement. Now, some of us might be very interested in using a Roth IRA, but our income is higher than the IRS says it can be in order to qualify to utilize a Roth in its traditional sense. So if you can't use a Roth IRA or can't contribute to a Roth IRA, your next option is a traditional IRA, and that account acts very much like a 401k, so you're going to get the tax benefit up front when you go to contribute. Your investments can grow tax-free, and then when you go to withdraw, you will pay taxes on that withdrawal. So now we have a 401k, a Roth IRA, or a traditional IRA, and what should we invest in it? And I'm going to cover this part because the last thing I want you to do is open an account, put money into an account, but don't actually put that money tied to an actual investment. The investment that I like to talk about when it comes to retirement accounts is target date funds. So a target date fund is going to take your retirement age. It's going to do all the math for you that says, I want a certain bond percentage, I want a certain stock percentage at the beginning, and I want to end with an optimal percentage towards the end and when I inch towards retirement. The cool thing about Vanguard's target date funds is that they are very low cost when it comes to expense ratio. The thing I love about them is that they are incredibly transparent when it comes to portfolio composition. So this isn't like a mutual fund within a mutual fund that you do or don't understand. Vanguard actually makes this super simple and shows you Vanguard's total stock market percentage mix, Vanguard's total international stock market index funds mix, the bond market that they have in here, and the international bond fund that they have in here as well. And in my mind, this is super easy to understand as you become more knowledgeable about investing and looking at different index funds. I've looked at other target date funds, and in particular, the one that I had in my old 401k, which I'm now out of, it was a mutual fund overall. The expense ratio was 0.36%, which is 8 times the expense ratio that I have now. And so I just highly recommend that when you look at a TDF or a target date fund, that you look at what the portfolio composition is and make sure that you understand what's being mixed in your portfolio over time. So we have now understood our numbers. We have an emergency fund. We know where we're going with our debt, and we have accounts open that we can invest for our retirement with something that's simple and automated like a TDF, so that we don't have to worry too much about asset allocation and all of that jazz along the way. And if you like this video, go ahead and give it a like, subscribe to our channel. Joseph and I are posting videos weekly about our life here in Portugal, about our journey to financial independence, and how we're working to design our life on our terms, even as a family of 4. If you're thinking now, hey, I know all this information, I need to go open an account, I actually created a video last week that talks specifically about opening a Roth IRA with Vanguard and investing your first $50 with VOO. So you can check that out here. And I hope today's video gave you some food for thought on how to give yourself permission to be wealthy.